So is this a soft landing trade? Is the market right? Or has the January jobs report changed the landscape in some way? Blackrock says it sees the market and central bank disconnect resolving and favoring higher rates. Joining us now to break that down is Wei Li, Blackrock Global Chief Investment Strategist. Wei Li, thank you so much for being here. So, given what we just heard Jared talking about, given where the markets are, given what we heard from the Fed and the jobs report this morning, there's a lot buzzing in our heads, obviously. What do you think is the likelihood of that soft landing scenario at this point?
Well, if we look at market pricing so far this year, it's not even pricing in soft landing. It's pricing in takeoff, right? It's pricing inflation to come down. It's pricing growth to avoid a recession altogether. It's also pricing in central banks cutting rate starting mid this year. So that is really markets priced for perfection. And in the near term, beyond FOMO and chasing momentum, it's hard to see a fundamental reason for stocks to keep pushing higher. You talked about the very strong labor market. Indeed, I mean, like we always thought that labor market is very, very tight, but even this number is higher than our expectation. Maybe there are some seasonality factor at play here, but the bottom line is that the effect of the over-tightening by the Fed have yet to be felt by the labor market. And that means service inflation is likely going to be persistent. Core service inflation ex shelter is likely going to be persistent because of the wage component. And that means actually interest rates, yes, they will peak and they will pause, but they won't be able to start cutting rates this year, which is also why we're currently underweight developed market equities. We prefer emerging market equities because of global dynamics with China reopening. And in fixed income, we want to stay in high-grade credit for their income potential, and we also like front end of the government bond market because of the income potential.
Okay, so that starts to get into what my question was, because for a lot of investors out there, their New Year's resolution was just simply in 2023 not have the same type of losses that they may have had in 2022. And so now for them, what is the disinflationary environment portfolio playbook that they can enact and strategize?
Well, if you believe that we're in an environment of disinflationary, inflation falling down very, very quickly, not only to 4%, 3%, but all the way to target, then it's a outright risk-on type of playbook, which is essentially what markets have demonstrated so far this year. But because of our view that it's easier for inflation to get to 4% just from good service rotation along, but to go from 4% to 3% and below all the way to target, then we're talking about the sticky components of inflation related to wage, which is hard to actually see that transpiring, which is why we wouldn't kind of chase this momentum at this juncture. I would say, though, to your point about everyone starting the new year wanting to avoid the sort of performance that we saw last year, there is a lot of cash being deployed to participate in this rally because of FOMO, fear of missing out. And I think that explains part of the momentum that we're seeing, and just in addition to short squeeze that we have seen some signs of as well.
And alongside these jobs numbers today, we have earnings season still going on. Tech, of course, wrapping up. What have been some of your biggest takeaways?
Well, we're actually seeing signs of margin pressure coming through, right? So we're seeing sales growth outstripping earnings growth, which is the result of margin coming under pressure. Expectations have already been lowered, and yet beats is below historical average. So we're actually seeing what we would expect from earnings, but that's not being listened to by markets. Like even the misses are being rewarded with positive return on the day of the earnings release, which means that the attention is focused elsewhere. It's focused on inflation. It's focused on central banks, not so much on the fundamentals. But at some point, as technical factors wash out, focus will shift back to fundamentals.
Are the fundamentals bad for corporate America?
At this juncture is not going to be as good as what markets are pricing for. We are expecting a mild recession. We are expecting a mild earnings contraction around -6% for S&P 500 versus currently markets pricing in high single digit for earnings growth. So we're not expecting a very, very bad outcome for fundamentals, but currently market pricing is very good, and that's where the disconnect is.
Some execs have tried to pivot the attention towards their international business and primarily looking at at some of the potential rebound or the growth in India and China particularly, which kind of mirrors what we had heard from the IMF. But is that enough in that kind of global picture to buoy them or offset some of the declines or near-term headwinds that they might see in the U.S. and EMEA?
Well, if you look at how oil price has performed, it's fallen a bit, but it would have fallen a lot more if China restart didn't pick up momentum as we saw so far this year. So this theme that you talked about in terms of pivoting towards international market is also how we see our equity allocation currently playing out as well. We see U.S. equity markets being kind of priced for perfection at this juncture. International equities look more interesting. Emerging market equities look more interesting, especially given the context of a weaker dollar after last year as well, and also the fact that, yes, we see recession, but it's a mild recession, so we can move on and move through it.
Always great to get your insights. Weili, Blackrock Global Chief Investment Strategist. Have a great weekend. Stay warm.
Will do. Thank you.
All right.